Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking another look at Ulta Beauty. It's been a few months since we last took a look, and now we have essentially a full year's worth of data more than we had. Last time I put out a video, it was why is Ulta stock down so much? And it was right around this point in here, we were seeing the fair value getting reached. And I put it on the buy list. I personally bought some, and then after that, the stock went on a huge run up to a peak of $574, and now it's going back down again. So a very volatile stock. But now that we have a full year's worth of data more than we had last time, we can recalculate the fair value. And last time it was about $408, and the stock is just below that right now. But after I recalculate, things are looking even better. So this is what we're looking at now, $447, so $40 growth in the fair value of the stock over the course of a year. Not quite 10%, and our thesis is giving us the same returns going forward. So things are looking pretty good here. A few months back, it was on the list of stocks to avoid, and it only appeared once. I just took it off after this last one because the stock was down 30% from when I put it on the stocks to avoid list and right at its fair value that I had calculated. If it stays at these levels, it'll probably end up on the stocks to buy list. And that's how volatile this is. 1 month you're buying and then you're profiting $200, and then all of a sudden it's back down to around the level that you bought in at. Earnings yield looks a little high. We'd like to see that closer to double digits, but it's fine where it is. Earnings-wise, their valuation is pretty good, and they come in with really strong earnings. Cash flow yield, right around 10%. That's where it traditionally stays. That's what we like to see, double digits. I'd like to see it going up, not down, but that's not bad. They don't pay a dividend. In fact, they're going to pay a special dividend, but that isn't going to factor into anything here. ROE, ROI, and ROA all look very good. Nice double-digit returns on everything. Debt to equity above 1, but it is decent. It's retail, so you expect higher debt for the inventory that they're holding and for the retail spaces that they own. So for retail stock, we can tolerate that. Margins, almost 40% gross. What we like to see, 30 to 40, and net above 10%. So everything here looks really good. Here over for retail stock, very good. Earnings yield a little low. Cash flow yield a little low as well. But nothing to worry about there. So now to put together a thesis, we've seen good growth over the last few years. 9% CAGR for the 3-year, 3% for the 2-year. Analysts are expecting 4.75 for this next year, and then over the next 2 years, 5.5. So we're going to use 5 for the thesis and see how that plays out. EPS growth looks good with strong revenue growth and share count buybacks and share buybacks, which is what we really like to see. If they don't pay a dividend, at least if they do buybacks in the realm of a healthy dividend, it probably benefits you more with not needing to pay taxes and potentially locking in some long-term capital gains. Cash flow growth, 6.5%, would hold them at right about 10% over the next 5 years. We'd like to see that go up, but even this is a lower case scenario, just in line with how they typically perform, and it seems to be fetching a pretty good result. Assets, they've been growing them. I want to be a little bit safer, not expect them to grow them too much, because there's some good growth they're on a good rate of growth in those assets, but 5% should definitely be pretty fair, safe with what we're seeing. Liabilities, growing as well, but to a much lesser degree. 3.5 to 2.5 seems very fair. Margins, I mean, they're pretty flat on the gross and the net, so I wouldn't expect too much growth. It'd be nice if they can get above 12, though. So that'd be 1% per year. All of that, buying at today's price, you're looking at beating out the market in 3 years by 3% and in 5 years by 8%. So you're squeezing out some really nice growth there. Average returns of just shy of 10%. Stock in line with the upper end of what we expect from markets. Decent valuation right now. I mean, things look really good for it. I did sell out because I thought that it was getting very expensive in the 500s, and now that it's back down in the 300s is definitely where I would like to buy it. I mean, it's been as low as 368 in the last 52 weeks. And buying at that level, you're almost doubling market returns in the 3-year. Let's see, I'm taking a look at my history on the stock, and looks like I purchased at 389 and at 397, and then I got out at 515. So quite the swing in there in a short period of time. Quick look at everything graphed out. Financials, revenue looks really good. COGS flattening out 2022, 2023. Revenue did as well for the most part. Gross profit, net profit, and EBIT. We see some great growth in the EBIT. That's what really matters. And again, everything looks like it kind of flattened out from 2022 to 2023. And that's probably why we're seeing such a roller coaster. Lots of growth is expected. They didn't really come through with it. And now it's expected again. So we'll have to see how this year plays out. Balance sheet, great asset growth here. And they do have tangible assets, which is what we like to see, and a tangible book value. Liabilities are growing as well, but clearly not at the same rate. Cash flows kind of dipped down there for a little bit, 2022, 2023, and then we are looking for them to get back up to that average of 10% or more in the next 2 years. And then a quick look at everything graphed out. The balance sheet is down here, the lowest, only bringing in $167 worth of value. It's only bringing in $167 worth of value down here, but you then have the fair value kind of lagging the earnings and the cash flows being pulled down by that balance sheet. With a retail stock like this, the balance sheet doesn't have as much of a weighting. That's why we see it way up here. Earnings-wise, trades pretty well in line with the earnings, honestly. Back in 2021, they were spot on. We saw a little bit of gap, but it is closing over time. And then the cash flows are way out ahead. If they can keep that up, cash flow is the most important thing for a stock. If they can continue with strong cash flows and share buybacks, then things will be looking very good here. And that's why I'm back in the stock. I'm putting it on the list, and we'll follow along. It'll likely show up as a stock to buy in the coming months because we just did May. So if it holds around this level, even dips down into the especially if it dips down into the 300s, then these numbers will put it on our list for sure. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.